Friday's unemployment data confirms that the U.S. economy remains strong and the labor market remains tight. Our next guest says this allows less room, if any, for the Fed to cut rates further. Market expectations now suggest that the Fed may be done easing, signaling a potentially more hawkish stance. So how might some rising yields, a stronger U.S. dollar shape financial conditions moving forward for companies? And what does he expect ultimately to be the ongoing theme through 2025 rather. Joining me now to unpack all of the macro themes for 2025 and on his radar, and to set you up for the trading week here that we are entering into, lots of data points and earnings we are on the cusp of, is Fidelity Director of Global Macro, Jurrien Timmer. Hi, Jurrien, how are you?
Good morning.
Where from? Good morning from?
Yes, I am at my brother's house in Aruba, where I was born and raised, as many people know. And my parents, who are 90 and 97, are still making their pilgrimage back here. So they arrived about 3 days ago, and I didn't want to miss the opportunity. So I'm dialing in from Aruba for this week.
That's wonderful, and I hope you have a great family event and enjoy it. Thanks for joining us. Why don't we ask you a little bit about what is classic about some of the things moving in these markets right now. Good news was bad news last week.
Yes, so we are sort of, the cycle is evolving as it always does. And of course, when a bull market begins, as it did 27 months ago in October of 2022, of course, expectations were very low. And as cycles evolve, things change, right? The market gets more expensive, which is typically what happens as a bull market advances. The PE goes up. Earnings start to do the heavy lifting, which is exactly what they are doing, what they did do in 2024 and are expected to do again this year. And earnings season, as you mentioned, is right knocking on the door here. But, as we talked about late last year, at some point, tailwinds become headwinds. And on the interest rate side, that certainly has been the one we've been discussing for a number of months now. And so we had the election, of course, that kicked in some serious animal spirits. If we go to slide 8, you can see the flows into equity ETFs and funds here in the U.S. And that happened for good reasons. The economy, as you point out, is resilient. The jobs market is still quite robust. And so the economy looks good. But, tailwinds that we had last year, right? Last year, the Fed cut 100 basis points. I think those tailwinds are over. Not to say that they are now headwinds, but I think as the Fed itself had said, and as the market is now telling us, really that 100 basis points might be all we get, which is not the end of the world when the economy is strong. The economy doesn't really need the Fed to cut rates, but the action on the long end of the yield curve, if we go to slide 2, that's really what I think a lot of this is about, right? So the bond yield, the 10-year yield, is kind of, again, approaching 5%. The last time it did that, which was in October of 23, that caused a 10% wobble in the stock market. And of course, 2022 was all about rising rates, both on the short end and the long end. And the term premium, which you see in the orange, which has been long suppressed by central bank policies, which of course is the purpose of QE and zero interest rates, is to suppress term premium to make the risk-free asset more expensive and therefore to have money flow into riskier assets. So, but those days are now behind us. The Fed is still doing quantitative tightening. It's probably not going to cut rates too much more, and so the term premium is reverting to a more normal level, which in my view is probably 100, 150 basis points. And the important thing to realize here is that it's one thing when yields were 1% and they go to 2%, like, who cares, right? If the stock market is yielding an earnings yield of 5% and the risk-free rate goes from 1 to 2, like, stocks are still the best game in town. That was what we used to call the TINA trade. There is no alternative. But now bonds are close to 5%, and the stock market is yielding 5%. And the stock market, as the riskier asset, although some people might argue with whether that's still the case, should yield more than the risk-free asset. And if the risk-free asset becomes cheaper, which is what it's doing, the stock market needs to correct its own valuation to remain competitive. And that dynamic is elevated even further now that bonds are positively correlated to stocks.
Right.
So stocks need to compete with the risk-free asset. And this is what the Fed model back in the 80s, so during the Alan Greenspan era, was all about. And I think the Fed model is back. Actually, that's slide 4. We can go there real quick. And so, back in a couple of years ago, in 2020, during the height of the pandemic, the bond PE, which is the inverse of the yield, so basically the price that investors are paying for the coupons that they're going to receive, the bond PE was 91% higher than the equity PE.
Wow.
Now the bond PE is 15% lower than the equity PE. So it's a different dynamic, and it's an area like you see there during the red shading which denotes the correlation between bonds and stocks. It's something that the stock market needs to pay attention to, and the kind of the indigestion we're seeing in the first few weeks of the year, I think, is exactly based on that dynamic.
It's fascinating also to think about the discussion of valuations, which you've brought up many times, and where they got to through last year, and sort of the expectations of whether they can go further and so on. You had mentioned that if one of the megas, basically, which have made the S&P 500 so much of what it is over the course of the last 2 or 3 years, were to falter, what it would mean ultimately for the market. This has been a discussion that you've brought up for some time. We are seeing a little bit of that today, just as sort of a live story, but I guess just bring in how we should frame that.
Yes, so let's go to slide 9. I mean, that is one of the big questions, right? So the Mag 7 are over about a third of the market, right? And that is pretty top heavy. And of course, the story has been legit. The AI story, we know that this is, as game changing, if not more, than the internet era a few decades ago. But those stocks and their earnings are skyrocketing. So the fundamentals support their leadership in the market. But having said that, they are more expensive, as they should be, right? Because they're secular growth stocks. And it brings me back to kind of this market cycle framework where, last year we had the market fired on all cylinders because earnings grew about 10% and valuations grew about 20%. So 2/3 of the market's very robust performance came from rising PEs. But when expectations are high, it doesn't take much to disappoint. And so not to say that NVIDIA or the other Mag 7s are disappointing in my view, but it just, you get to the point where not only do they have to meet and beat estimates, they have to raise guidance, and it becomes a harder game to play because at some point, those expectations that keep getting raised by the theme that is underway are reflected in the price. And you just get to a point where even good news is not good enough. And again, I'm not saying that NVIDIA and the Mag 7 are there. Back in 1999, during the dot-com era, Cisco, which was kind of the NVIDIA of the internet era, before the final peak happened in 2000, it had many, many episodes where it would fall 25, 30% because of exactly the kind of thing we're seeing now. And it was not the end of the line. So I wouldn't want to overread what's going on, but a top-heavy market, can be a concern. And actually, if we go to slide 6, I show here the S&P 500 equal weighted index, and the loss of momentum at the end of December was really a little, it raised my eyebrows for sure. We went from, 3/4 of stocks above their 200-day moving average to half, and this chart shows the 50-day moving average. We went from 71% to now 24%. And so there is a loss of breadth in the market, and in some ways we're looking more like 2023 than 2024. So we're just getting these headwinds here, or cross currents, I should call them. And I'm still bullish. I think this is still a sort of later inning bull market. We've talked about the seventh inning. But this is the time when you would expect to see tailwinds turning into some headwinds, like the rate side, like the valuation side. And of course, we should mention the very strong dollar, which is on slide 3. The dollar is soaring, right? And so the dollar is going up while rates are going, or yields are going up. That leads to a tightening of financial conditions. I mean, that's a remarkable chart. And of course, you in Canada all
we know it
experience
too
this.
well.
Yes, you know it too well.
Painful.
But this brings me to slide 14, which is kind of my version of the investment clock. And there's a lot going on here, but the point of the chart is that the upper left quadrant. So here I'm showing the juxtaposition of financial conditions, which is based on interest rates, the dollar, credit spreads, et cetera, the stock market, of course, as well, and earnings growth. And we have 2024, in 2024, we were in the upper left quadrant, which is the sweet spot. It's when earnings are growing and financial conditions are very accommodative, and that's like as good as it's going to get. And now we are sort of transitioning, it seems, into the upper right quadrant, which is still positive earnings growth, but no longer those easy financial conditions. And it's interesting that if you look at the red line, that's exactly where we were in 2018. So, right, 2017 was the first year of the first Trump administration. And like 24, it was a very robust year. I think it was like 30% year, a combination of strong earnings growth because of the tax cuts, plus a healthy valuation gain. And 24 kind of is very similar to that. And 2018 was a more sideways market. We had the Volmageddon episode in January, which, I'm not expecting a repeat of. But then we had in the second half of the year, Jay Powell normalizing rates. I think he went all the way from 0 to 3 and change. And then the bond yield went up. And then we had that correction in late 2020. And again, I'm not predicting a repeat, but my point is that you had a very strong earnings growth year, but it was offset by other pressures coming from rates and valuation, et cetera. And I think that's sort of, 2 steps forward, 1 step back is what 25 is going to look like, but still 2 steps forward.
Okay, great. You did mention that the Fed could just sit here. I mean, there's another rate cut priced in actually at this point. But that said, with everything you just mentioned on the dollar, I want to ask you about the loonie, the Canadian dollar, in a second. But yeah, I mean, they could afford to not move.
Yeah. So that's slide 1, and so again, the Fed cut rates 100 basis points last year. It went 3 times, which is exactly as many times as it said it was going to do a year earlier, right? Remember when the pivot party started? That was in December of 2023.
No one believed them, but that's what they did.
No, yeah. And the market said, well, we'll take your 3 and we'll add 4. And of course, the Fed ended up being very much correct. And as you can see, that dotted line is the SOFR curve, the forward curve. And it is suggesting a bottom Fed funds rate, I should say, of 4.13% sometime in this year or next. And that is actually above the dots, which were recently updated. So I think the market has this right. And I think the Fed is saying things to the effect of, let's just wait to make sure the downside momentum that we've seen on the inflation rate in the last couple of years remains in place. And as we know, the inflation rate, the core inflation rate, really didn't do much last year. It's around 2.8, 3%. And I think the Fed is rightfully waiting for that downtrend to resume. And of course, in the meantime, we have pretty strong economic data. So I think the Fed should stay where it is. It's much better to wait than to go too fast and then having to take them back, because that really is very disruptive. That's what the Fed did back in the late 60s. It wasn't a good outcome. So I think the Fed is doing the right thing. I think the market is in the right place as well. And my guess is the Fed just sits on its hands. And again, the labor market is quite tight. If we go to slide 5, You can see the latest JOLTS report, which was released a few days before the payroll report last week. And you can see there kind of in that green shading, the pandemic era where the economy reopened very quickly, at least in the US, but the labor market wasn't ready because people had exited the labor force. And then it took a while for the labor to return, either through people re-entering the labor force because after an early retirement or whatever or a more favorable immigration policy. And we're still kind of in balance where the demand for labor is in balance with the supply of labor. But the latest report shows a ever so slight uptick, and it does suggest that the labor market remains tight. So with inflation no longer making a lot of progress towards 2%, the labor market being pretty tight, consumers being employed, not having a lot of debt in the US and spending money, there's really no reason the Fed needs to go hard right now. And I think the stock market from that perspective is totally fine. It's the long end of the yield curve that I think is the problem here.
Okay, so I want to talk about it. There's just a couple questions coming in, but we'll go back to that approaching the 10-year approaching a 5% yield. To tie a couple of currencies together and also Bitcoin, you mentioned the US dollar, how much higher can it go? There's a question saying how much lower can the Canadian dollar go? I do kind of wonder if you can answer that, but also go to Bitcoin. Like, do other types of assets, including perhaps crypto, become more attractive when you see the dollar doing what it's doing right now for other countries, for other places?
Yeah, it's a great question. And so, certainly Bitcoin had a huge run up since the election, partly for good reasons, because the idea that a more crypto-friendly administration is coming in, which clearly is the case. Gary Gensler, not to name names, is out, and so the sense is that the new administration will be more crypto-friendly, will try to get decent regulation going that gives investors a little bit more confidence that it's not going to be an onerous, anti-crypto regulation. And there's some hopes, which I think are maybe misplaced, about a strategic Bitcoin reserve. I'm very skeptical of that. I don't think the US dollar needs it at all. We've been on a fiat system for over 5 decades, and the dollar has been just fine. Thank you very much. So it's not like we need hard assets in the Treasury's Exchange Stability Fund, which is where they would want to put it, to make the dollar a sounder currency. So I think that's kind of pie in the sky stuff. But the government is sitting on a whole bunch of Bitcoin that was seized from illicit activities, and they could, instead of selling it, just put that in the fund, and that would at least mean less selling, right? So, but what we're seeing now is Bitcoin's back down to 93,000 after going to 108,000, and it's doing what it always does, right? And it's doing what markets always do, and that is it's going through ongoing price discovery, which means that when new information comes in, the market trends, right? So that's the Mag 7 and AI, like new information makes the market search for that new fair value level. And sometimes it goes very quickly and you have a strong trend. And that's what happened with Bitcoin during its adoption phase. And again, after the election, and it didn't hurt that, risk appetites were strong anyway, because there is part of Bitcoin that is a store of value, but there's parts of it that is a speculative risk on asset that looks like the NASDAQ, right? So there's that element. And as the stock market is now correcting a bit, it's not surprising that Bitcoin is correcting as well. But when the markets are not trending, they're in some sort of consolidation phase where they are waiting for new information. And the stock market, I think, is in that phase, and crypto is in that phase as well. And those phases are either continuation patterns, which ultimately resolve themselves in the direction of the prevailing trend, or they're what we call reversal pattern, which means tops or bottoms. And my sense is that Bitcoin is just going through the same kind of congestion that many other assets are doing. And so I think it's less tied to the US dollar and other currencies right now, and just more tied to what the government will do with its Bitcoin, and what kind of regulation we will see, and whether that speeds up the adoption.
Really interesting. A little bit more, if you would, on the discussion of momentum and possibly pointing more to stock picking, for instance. But momentum has really, you discussed it last week. It was the train to be on.
Yes, last year was definitely about the momentum trade. And I think that obviously has been interrupted now, since the middle of December. So I'm waiting to see what happens here. My guess is that the 10-year yield will test 5%. Maybe the stock market has a 10% correction, maybe even more. We've had several of them, since the bull market began. We had one last summer when we had that little growth scare. We had one in October of 23 when the yield went to 5% the first time. So I think they're good, they're healthy. Like, the more little speed bumps you have along the way, the less risk you have that this whole thing becomes a giant bubble that then collapses. So I personally like corrections, and for everyone listening, corrections are an opportunity to rebalance and to kind of check where your assets are, what your allocation is. And so, these are good opportunities. But I'm looking at that those breadth numbers, because one thing that does concern me is that, again, a year ago at the end of 2023, 2023 was a year where the stock market, the U.S. market, went up, more than 20%, but it was very, very narrow. It really was. If you were not in the Mag 7, you were not enjoying the ride. And so at the end of 23, only 26% of stocks outperformed the index for that year. And then 24, we had the bullish broadening. We went to 75, 80% being up, and the percent outperforming went to closer to 50%, which is about the average historically. And then all of a sudden, the last 2 weeks of December, we're back down to 29%. And so, that's something that I would like to see a broader market again, like we saw. And again, it will come down to earnings. And just to pop up slide 11 again, which is where we started, we are on the cusp of earnings season.
We are. It's just around, it's exciting.
Yes. And so the growth estimate, which is the black line, so this chart shows what happens going into earnings season and then during earnings season. And this is a familiar pattern, but the growth rate usually comes down because the estimates start too high. Companies guide lower so that they can beat lowered expectations, and then you get this bounce. And so the starting point for this earnings season is a 7% growth rate. Usually we get about a 300 to 500 basis point bump. So the last few quarters we saw double-digit growth. Right. My guess is that this quarter we'll see it again. So earnings are not the problem here. They are definitely a ballast, or not a ballast, but they are one of the engines for the market. The big question is, to what degree do the high valuations and the ebullient sentiment, and then again a bear steepening yield curve, to what degree do they offset that strength in earnings? And does it favor just the Mag 7, or does it hurt just the Mag 7? And that kind of comes back to a point you raised earlier. One of the things we're always debating here among our colleagues in the asset allocation group is, you got this concentration. What happens when those stocks lose their luster? And again, I'm not predicting that they will, but when that happens, what does it mean to the market, right? Can the market go up when that happens and continue to bullishly broaden? Or are these stocks so top heavy that they just pull everything down? And then the question is, then what happens to, for instance, value stocks and small caps and non-US stocks, whether it's EFA or EM? Clearly, those are being affected by the strong dollar, right? If we just go to slide 10, you can see how the earnings estimates for non-US stocks are coming down, which I think is mostly just the dollar, because the way these indices are computed by MSCI is they're all computed in dollars. So I don't think that there's a cyclical downturn going on in the rest of the world, but the dollar estimates are coming down because the dollar is going up. And so the question is, if you're long non-US stocks, for instance, IFA or EM,
Or
and
Canadian,
you win,
or Canadian,
or Canadian, yeah, absolutely, and you win on a relative basis, are you also winning on an absolute basis? So it's a beta versus alpha question, and that's one that I'm really struggling with, because these stocks are so big that if they go down, probably the market goes down with it. And then maybe all markets go down, but the other markets go down less because they just have less room to fall because they didn't go up as much, and their valuations are 14 when the US is 22. But it becomes a relative alpha game rather than does the market go up or down.
So I just want to ask, in light of absolutely horrific, and you spend time in California, I just can't even imagine. Everyone's thoughts are with the people of California right now. From a perspective of earnings for any company that would be exposed, I mean, it could be insurance, but it could be lots of other companies too. The idea of event risk is always something in earnings. That's always something that can happen for a particular quarter, or you take a big hit somewhere. Again, if you can almost frame that into the markets we are in, can we handle some event risk, is the question, in earnings?
Yeah, no, it's a great question. And yeah, it's just, I have many friends in LA, and even the ones unaffected by the fires had to evacuate. And just the scope, I think they're looking at $250 billion of losses, and obviously lives lost. And you just think about the supply chains of trying to rebuild 10,000 structures. I mean, it's crazy, but it's like a hurricane or an earthquake or fires. Economically speaking, it's certainly in human terms, it's obviously catastrophic, but economically speaking, what's lost gets rebuilt. And so it's sort of that broken window, syndrome that, whatever economic activity you lose, right? Because restaurants had to close and schools are closed and this and that, will get rebuilt, and the market will look through that beyond sort of specific sectors, right? Obviously property and casual companies and things like that. So I don't think it is a headline risk from that perspective. But obviously, it's super disruptive. California is, the fifth largest economy in the world, and of course, LA is a very large economy on its own. So it will definitely be disruptive. But whatever we lose on the front end, economically speaking, will be gained on the back end as buildings get rebuilt. So I think the market tends to be very efficient in looking through that. It's not a permanent loss.
Right. Thank you. Okay. Very helpful. I just want to end, if we could, on the 5% yield of a 10-year. It's an if question, and possibly a when. Can equity markets sustain it, even if it's just sort of hitting it and bouncing back down?
Yeah. So clearly, what we're seeing over the last few years is that 4.5 to 5 is like that yellow zone, right? I mean, if we went above 5, that would be the red zone. But I think that at 5%, the term premium, and we can maybe pull back slide 2 again. I know we're running out of time, but that term premium has now gone from negative 150 basis points, 10 years ago, to now plus 63. So the market is repricing, so that's good. The term premium should be positive. It has no business being negative. The 10-year yield, according to my range there in the top, should be 4.5, 5. So maybe we overshoot 5. The stock market won't like it. It'll correct. It'll go down 10%. But it's probably an opportunity, and I think bond investors will step in above 5%. So as painful as it might be while it's happening, I would encourage everyone to kind of look at the next chapter that will come, and it will be an ability to rebalance at much better levels. So if there is cash sitting around, or if people have GICs that they can get out, that would be an opportunity to capture some higher value, some lower valuations on both sides of the 60-40 spectrum.
It's wonderful that you point out the opportunities to us and frame this week. Thank you so much for joining us. Jurrien Timmer, enjoy your time with your family. So precious. Great to see you.
Thank you very much.